Good morning, ladies and gentlemen. Great to see you all back for Boutiques on Wednesdays. Today, we're really in for a treat where the BCI team has assembled a fantastic panel of experts on fixed income and bonds. Still very topical if you look at current high yields and what it offers to investors. I think very topical in any conversation when looking at client portfolios. Joining us this morning as moderator to the session is Roelof Horn, Executive Director and Portfolio Manager at Miton Optimal. Good morning, Rudolph. How are you?
Morning, Eugene. Thank you for providing us with the opportunity to speak to these experts in the SA fixed income environment, some of them over 30 years experience and some touching to the 30 years. So a lot of wisdom around today.
Absolutely. And I mean, Rudolph, your background as well. You've got more than 20 years experience in the industry. And for the audience, for those of you...
30.
30 years, there we go. And for the audience, those of you who don't know, Miton Optimal is also known as DFM. And that term sometimes vaguely used among Cat 2 managers or people that assist intermediaries with asset consulting. But they are truly a constructive asset consultant helping retail intermediaries with constructing portfolios. They also do asset allocation modeling. And very important, they do a lot of fund manager research, kicking the tires and trying to establish who the most appropriate managers are for various asset classes. So you're more than welcome to contact Roelof after this as well if you need assistance in those fields. But Roelof, on that said, I'm going to waste no more time. We've got a full session today with 4 panelists, but I'll hand over to you to introduce your panel and the topic, and we are ready when you are.
Thank you, Eugene. Just to add to that, we're also independent and independently owned, so that makes us different within the DFN environment. Today we have Nolan Wappenaar, Conrad Wood, Rowan Williams on the call, and also Jonathan Meyerson. They represent Vunani Alawani, Jonathan Vizio, and Nolan Anchor, respectfully. So the important part here is that we want to address certain topics that's topical within the marketplace at the moment. And I will target certain individuals in terms of the question, but everybody's welcome to participate. And also from the viewer's perspective, to ask questions on the what you call it, on the provided question and chat screen. So my first question is really a topical one in terms of what's happening in Japan and the US at the moment. There's bond yields that have spiked up. Japan over the last 2 years, your 30-year, 40-year bond yield has spiked up from the lows of 0.5 or 1% to 3 and 3.5% respectively. In the US over the last 3 years, you've had bond yields move from, again, 0.5% to 5% in the 30-year environment, I think 4.5 for the 10-year environment. And we do know that there was a bit of a reset, and that maybe the last 10, 12 years in the bond market was irrational in terms of the happenings post the global financial crisis. But is it concerning that the bond yields, especially in Japan and the US, are now spiking even more north? And what does it tell us as fixed interest managers? So your mandates are very different between all of you. And I do think that it's fair to say, when I ask this question, put your hat on as a global fixed interest manager, unconstrained. And my question to you, and I'll go to you, Conrad, first, is at this level of Japanese yields or bond yields, is it a buying opportunity, or is it the time to get worried as a fixed interest manager?
Thanks, Roelof. I think there's definitely a reason for concern. I mean, I think the difficult part about these moves is that, I mean, if one looks at the kind of macro backdrop, one could arguably have expected bond yields to be going down right now, right? You've got global growth slowing, you've got inflation above target, but it's not massively above target, and it's fairly stable. And our view is certainly that it doesn't sort of, run away on the upside. You've got the potential for central banks to cut rates. So this is all conducive to a stronger bond market in the developed world, but yet you've got some of the big jurisdictions that you've raised, going the other way. So, it then behoves the question, well, flip, what the heck is going on? And should we be worried? And I actually love this term that was coined, and this is a real term that came about during Liz Truss's brief tenure as the UK Prime Minister. You can Google it. It's called the moron premium. And the moron premium is busy being priced into not so much Japan, I would argue, but particularly in the US. And this is just the bond yield's response to irresponsible and reckless policies that come through. And I think we've seen the bond market provide a handbrake for Trump and Trump's policies. It acts as a guardrail twice now, on the reciprocal tariffs and on this tax bill. The bond market reaction to both of those has been fairly violent. And I know there's this term, sort of bond vigilantes, that gets bandied about. I don't know quite who these people are, but they seem to exist. And it's collectively the bond market trying to hold policymakers accountable. Now, I don't know if this is kind of the last straw, and if it's D-Day and bond market is now reaching a point of no more, no further, or if it's a head fake, and it calms down and it comes back. But we're just seeing a little bit of a revolt in the bond market, despite that macro backdrop that I've highlighted, against some of the policy profligacy that's going on, particularly in the developed world. And so you've got rising yields and rising risk premia, steepening yield curves, as I say, at a time when you would arguably expect the opposite. So as a global fixed income manager, we see, I think the place to hide is in shorter dated bonds that would be much more correlated with the rate cutting cycle and would likely do well under that. And you avoid the longer dated bonds, as this long end of the yield curve reprices. It's not irrelevant for a domestic fixed income manager either, though. The knock-on effects to South African bonds are going to be interesting. Does this remain a US or a Japanese particular, centered problem? Or does it spread as almost a global kind of correlation trade where all bond markets, respond? And I think that's going to be quite interesting for South African bonds. But yeah, I think concerning times in developed market bond markets particularly. I think there'll be, I'll end off now. I think, it's not going to be one-way traffic. I think there'll absolutely be a policy response if it gets too bad. So this notion of policymakers stepping up and doing yield curve control or quantitative easing to kind of stop the rot would be in play. But I would argue that it's a little bit different to last time when they did quantitative easing. You've got inflation above the target, you've got inflation under pressure, and you've got the tariff impact still to come through on inflation, which I think makes using QE a little bit more dangerous this time around than previously, and you would run the risk of some sort of inflation impact if they were to try and intervene in the bond market. But something we're watching quite closely, Rob.
Thanks, Conrad. Thanks for that. And Nolan, anything you want to add? The bond yields have spiked up just before the weekend, and then it actually there was some central bank intervention, and I see this morning the yields are also picking up. Anything you want to add in terms of Conrad's overview there, in terms of the long end of the bond market in the US and developed markets, Nolan?
So Conrad, thank you very much, Rudolf, and appreciate being here firstly. But Conrad has obviously summed it up very, very well. What I would add firstly is that, if you look at the spread, the differential between US bond yields, 30-year yields, and Japanese yields, actually it's been pretty consistent. And in fact, if you look at the spread of US yields to German yields, it's been pretty consistent. So the point is that this isn't an isolated case of, one country really getting out of whack of the others. It's a global phenomenon, and everyone's moving in sympathy with each other towards higher yields right now. Why are we doing that? I think, the short summary is Dick Cheney, way back when, sort of coined the term for the Republicans that deficits don't matter. And the bond market would appear to disagree with Dick Cheney. We've seen every time talk of higher US deficits, the long-term yield goes up. Japan comes out and says, wow, we might reduce deficits. the yield goes down. Deficits do matter, and there's this factor sort of coming through it at the moment. That being said, we are in a world of increased debt. We are in a world of fiscal expansion, and a consequence of that is that your long-term bond yields prices are going to go up. But that's okay. So what is Anchor talking about at the moment when we sit in our sort of meeting rooms and discuss it? And the first thing we're talking about is we're looking at market positioning. And short interest, in other words, people who are taking positions in the market saying yields are going further up and prices are going to come down, it's almost at a maximum level over the last 10 years. So whether you look at the futures market, whether you look at the option market, the open interest of short speculative positions is kind of at record high levels for the last 10 years. It is a very crowded trade. Now, one thing my 30 years has taught me is that when a crowded trade reverses, it reverses sharply and it reverses strongly. So you want to be careful on betting on consistently weaker US bonds right now. Other point I'd make is that these crowded trades are centered around 3 months. So most of these futures positions, options positions, are expiring in August. Why August? Because Trump gave us a 90-day reprieve on tariffs, and this sort of just spans outside that area. So I think people are taking big positions on that right now. Next point we are talking about is tariffs. You know, I don't like tariffs. I've been very vocal about the fact that I think it's a silly policy. That being said, what tariffs do is they raise, it's effectively a VAT charge on imports. So companies that import goods have to pay extra VAT, and that is raising tax for the US Treasury quite significantly. Our estimate is probably at current levels, we're talking about $200 to $300 billion. That takes a significant edge off this fiscal deficit, and that hasn't totally been factored in by the market. When we look at what the market is pricing in, if you go and look at break-even inflation levels for the US, it is, you know, the market's pricing in almost a spike of inflation to about 4% this year. When we look at what the Fed is modeling, it's coming closer to about 3%. So we think that the market is overly conservative right now, and it's that moron premium that Conrad was talking about. But that gives us opportunity. Totally agree with Conrad. We think that the US 10-year is interesting. It's certainly not cheap, but it's definitely interesting. And we think that 5-year bonds are actually somewhat appealing. And you know what? If we're wrong, we're going to earn a ridiculously attractive amount of interest income. Fixed income markets where you want to be.
Thanks, Nolan. I see, Jonathan, you're itching to answer that question as well. And you have a longer dated mandate in your local fund as well. And Rowan, I'll come to you on inflation next. So, Jonathan, you want to add anything in terms of that topic?
Well, I think, you know, two parts to this is one, the economics part, and, you know, what we think inflation is going to do long term. And let's put a disclaimer out here. I'm sure Rowan will talk about this later. We don't forecast. We avoid forecasts. I can't tell you that inflation is going to be at 4 or 3 or 5 in the next 5 years. But what I can say is that the market is pricing in a certain trajectory, and the market ultimately is probably the best thing to look at. And it looks to me like it's pricing in inflation in the near term, in the kind of medium term, which is higher than it's been pre-COVID, but probably lower than where it is currently. And I think that makes a lot of sense to me, because ultimately we don't think tariffs are a inflationary driver. I think they're more of a, or at least in the medium term. Remember, a tariff like that is a once-off move. It doesn't repeat itself, and that therefore doesn't become inflationary unless the central banks essentially accommodate that increase by increasing money supply and keeping rates too low. But we think, to be fair, central banks essentially have basically been able to provide us sufficient comfort that they're able to manage inflation at reasonable levels. So, you know, so the question is really, you know, where to from now, and I think, you know, we can talk a bit more about, you know, where the value is and so on. But from our perspective in our fund, you know, we rather not point for an inflation outcome, but essentially look to what individual asset classes within the fixed income universe are pricing in, what inflation kind of risk premium we get for buying a certain bond. And we'll elaborate about that as we go on. But I think I'll leave it for now on this question, and let's kind of move on.
Okay, Jonathan, let's continue on inflation, and I respect the fact that it's hard to do forecasting even for equity earnings or anything out there in the current environment. But so the reality is you have inflation-linked bonds available to you as an instrument. Rowan, in terms of your process at the moment, do you see any value in inflation-linked bonds? Do you hold any in your fund, locally and offshore?
Good morning. Thanks, Rudolph. A very quick comment on the previous topic, DM versus South African bonds. It's worth noting that while South Africans have been lamenting the underperformance of our domestic equity market against developed markets, especially the US, for a long time now, the South African bond market has trounced developed market bonds for 25 years. Okay, 30 years actually, in any and every currency. So we've had far more headwinds than, say, the US in sort of macro concepts and political disasters. But this bond market is very good at pricing for bad outcomes. So yeah, we are more than 200 basis points per annum in dollars or any currency ahead of the WIGB over 30 years. Okay, inflation. Let's just set the scene here quickly. Unfortunately, most economists aren't very academically honest about assessing their own inflation forecast record. What they do the day inflation is released, they compare it to their update from the day before, which was 3 weeks after the event finished when they had 11 of the 12 data points. That's not a forecast, sorry guys. So I've done it for them. I'm a bit of a cynic and a statistician. So I've meticulously collected inflation forecasts from the so-called Society of Professional Forecasters, an oxymoron if ever there was one, in America, and the BER in South Africa. And I've done this routinely and rigorously for more than a quarter of a century. Here are the facts. In South Africa, the 1 year ahead forecast inflation average absolute error is more than 200 basis points. In America, it's over 100 basis points. Correlation between American forecasts of inflation and outcome inflation is well below 50%. It's not bad, it's spastically bad. Okay, it's unusable. Bond fund managers cannot use inflation forecasts. And I'll go a step further and wear a sort of CFA hat now. I actually think you breach your fiduciary duty if you manage other people's money on something you know you can't do, like forecast inflation. So I have sympathy with people who can't forecast inflation. I just don't have sympathy for those who don't confess that they can't do it. Let's take the US 10-year yield again. So I've collected tens of thousands of forecasts, so kind of hobby horse on the side, including company earnings, which are the worst of all. For 30 years, there have been routinely, professional forecasters in the US have nearly every quarter anticipated weaker bond yields. Now, despite the 4-year savage bear market in US treasuries recently, over those 30 years, with habitually weaker forecasts on yields, actually yields have declined from 7.5 to 4.5. So that's been completely wrong. So, Rudolph, what do we do? I'm thick-skinned enough to concede. I've tried econometric models, I've tried macro, every which way. Forget it. You can't forecast inflation. So long as you're going to get ugly surprises like war in Ukraine and suddenly 40-year high inflation and so on, abandon all hope. It's hazardous and it's dangerous. However, you can use a mathematical technique known as inference. Work backwards. What inflation rate is being priced into the US 10-year, the Japanese 10-year, the South African 10-year? So it's a process of inference which uses all the same fundamental variables that we know matter. And look, please don't get me wrong. Inflation matters massively for bond yields, more than current or fiscal account deficits, right? But if you can't forecast it, don't approach it that way. So if you work backwards, and I'll finish off, the South African bond yields currently demonstrably discount inflation higher than forecast or prevailing inflation. Therefore, as has been the case for a couple of decades in South Africa, yeah, we're going to have more ugly surprises. We're going to have more political calamities, but current yields adequately protect us from that. So it's a process of working backwards, Rudolph.
But
We're,
did you,
we're well
the
protected.
question was, do you
Our
own
bond market-
inflation-linked bonds? Do you own
Oh, so
inflation?
inflation-linked bonds, yeah. So we don't have one single break-even. That's naive analysis that unfortunately we see too often. You have a term structure of break-even inflation rates. My assessment is that at the sort of shortish end, inflation-linked bonds are better value than nominals. But as you get to medium to long end, you have better value in nominals. So the break-even curve is not a flat line. It probably should be considering counter forecast inflation. But if we go a bit more generic, which I think is where you're steering me, Rudolph, let's call the government ILB weighted average real yield about 5%. About. You can easily achieve that in an active portfolio. It's only in the good years that much riskier equities provide inflation +7. They very often provide inflation -7, right? But if we triumph of the optimists, as you know, that famous book, and if we say equities will deliver in the long run, and they might even do inflation +7, considering you have more than double the volatility of inflation linkers, there has to be a place for inflation linkers. I believe they're underused in South Africa, in particular for the old defined benefit funds and for insurance companies that have that can fairly accurately estimate liabilities. There's a very strong case for inflation-linked bonds. One thing that upsets me a little bit in the ILB market is we haven't had issuance from anybody but government for a very long time. If you go back 10 years, some of the SOEs and all the banks used to issue ILBs.
So it does mean it's a bit of an illiquid market too, from a certain.
The government market's liquid enough, Rudolph. It's nowhere near as liquid
enough
as
for the local managers. It doesn't really attract the foreign managers at the moment.
No, it shouldn't, because it's not their inflation rate.
It's not their liability.
They're very involved in our nominal market and our equity market, but it's quite natural that it's not their inflation rate, so they wouldn't. On the liquidity, very quickly, we have 2,500 bonds, but 11 of those, just 11, make up 90% of the trade on the JSE. Of those, 10 are nominal, 1 is an ILB. But for most of us, the liquidity in government ILBs is sufficient. And in nominal, it's fantastic. It's massive, the 4th most liquid in the world.
Is that one ILB a long-dated or short-dated government bond?
Longish, medium to long.
Yeah. Okay. Okay, Rowan, thanks for that.
Can I just throw a curveball just to make this a bit more interesting? Is that I absolutely agree. Short-term inflation-linked bonds are probably offering better risk-adjusted return to nominals and so on. But inflation-linked bonds are not a slam dunk, because actually, if you look at the history, they've probably been the worst performing real asset in South Africa over the last 5 and 10 years. So,
which makes them attractive now.
Which makes them attractive, possibly. But the point of the matter is they are very fit. They need to be fit for purpose. You know, one can't buy they come with a lot of interest rate volatility, and therefore management is required to take very close look at that. And just in terms of liquidity, I totally agree. And it is up to National Treasury to actually do a better job with providing the market with better liquidity and inflation bonds. It should be a very relatively cheap way for them to raise their funding, considering, as Rowan mentioned, is that essentially we are, as investors, getting a nice inflation risk premium from nominal bonds, which they're essentially paying. And that's something that's been highlighted to them, and hopefully that will change in due course.
Thank you, Jonathan. Rudolph, I'm going to ask for a 30-second indulgence to correct a widely misunderstood perception. If I buy an inflation linker yielding 4% real, it does not mean I'm going to get 4% real in the next year. Okay, please. I could actually wipe out in the next year. If held to maturity, even then it won't be 4, but it'll be close to 4. We don't know the reinvestment rate of the coupon. But yes, Jonathan, absolutely. I mean, all bonds, and especially ILBs, which are more technical, must, of course, be used judiciously, not...
Jonathan, I'm going to stick to you, and then I'm going to go back to Conrad and Nolan. But Sean Dupasson, I hope I pronounced that last name correctly, read my mind in terms of the next question, because he asked the question, and that is SARB and the MPC and rates tomorrow, but also inflation target that they're muting to say, let's go lower in terms of an inflation target. Your view on that, is that the right time to think about that? Is it the right time?
Yeah, it is very topical. So I think, you know, the idea of low inflation benefiting economic growth over time, which is essentially what the governor has been pushing really hard in his communication, in the conference that he had recently, is, kind of empirically justifiable. I mean, there's a lot of papers that suggest that. So, the question is, what is the cost associated with lowering the inflation target? So we currently have, for into purposes, it's 4.5. It sounds like they're looking for 3. If we get down to 3 in 5 years, it's going to be good for economic growth, all else kept the same. The question is, what is the cost to the economic growth over the near term? And in terms of timing, currently, there's no doubt that our economy is really struggling. So I think, the Reserve Bank takes the view that it can't impact growth in the near term, but it can put together a kind of framework where long term it benefits economic growth. But the point of the matter is that we are essentially, I actually think that economic growth in the first quarter of this year could end up being negative. Okay, it's data that's already available. It's going to be close to 0. And therefore, if there's a sacrifice ratio, in other words, if you target 3% now rather than 4.5%, it does imply that you keep interest rates higher for longer to get that lower target. And it also implies that on the margin, it constrains economic growth even further. Now, is this the best time for that? Clearly not, because we're struggling. But on the other hand, the Reserve Bank's making the argument that with inflation at 2.8, this is exactly the time to implement a new inflation target, which is lower, because the market's already starting to kind of visualize and rationalize inflation of 3%, and that's acceptable. There are very mixed messages coming, I have to say. The one day, the Deputy Minister saying the new framework is about to be published soon. Then we meet with National Treasury 3 days later after the budget, and they say they're not sure what he was talking about. What is soon? It could be November. It's going to have, in the near term, it'll have a material impact on the bond market. We can see just from news from news releases how it impacts the market. Longer term, on its own, it is not going to be the solution to economic growth, clearly. And that's totally different. So the governor is correct. Long term, it's a good thing, but it's not going to be the main driver. And on its own, without proper structural reforms that grow the economy, it's going to be challenged heavily in the near term, in the next few years. So long story short, I don't think it's the best time. There are more reasons for why not, but I think it could very well be implemented in the next 6 to 9 months, maybe in MTBPS we get much more about it.
Interesting. Thanks, Jonathan. I want to give Nolan and Conrad some airtime in terms of a different question, and that is opportunities in the SA bond market. And if you want to discuss offshore opportunities, you're welcome. And I think the viewers would also like to get a handle of what we can expect from the MPC in terms of rates from here, and what that means for short term interest rates in terms of your solutions that you manage. What's the kind of yields that investors can sort of expect under the current regime? And my last question, if you can answer all 3, and I'll go to all 4 of you on the same basis, because I want to end with a specific question, are there any risks in terms of the local corporate bond market or tier 1 or 2 tier bank paper, or is it just simply not attractive enough? So I'll go to Nolan first. Nolan, if you want to respond on what can we expect from the MPC in the short run, meaning tomorrow? B, what's the yields that one can expect from the solutions you manage? And C, are there any risks that one should be aware of in the SA fixed interest market specifically?
Sure. I'm going to begin by quoting Rowan, which is, economic forecasts are reasonably accurate for tomorrow, but pretty bad for 2 years out. And from that perspective, MPC is kind of tomorrow. So Anchor has gone out there. We are different in our perspective to most. We are saying we still see scope for a further 3 interest rate cuts in South Africa. Now, bear in mind the market is pricing in maybe 1, possibly a second. So we're probably more bullish on interest rate cuts than most. And that's how we're positioning our funds. And part of that is portfolio construction, because if we're wrong, it's actually not going to hurt, and our investors will actually benefit. It's kind of, a different form of upside, given how we've positioned it. That being said, what do we think tomorrow? The market is pricing a 66% chance of a cut. We are totally in that camp. We think you get an interest rate cut tomorrow. We think you get another one in July, I think is the meeting, end of July. And thereafter, we think once the US starts cutting in the second half of the year, the pressure will build for a third cut. I am the one here who was quoted on Citywire as having said that shifting the inflation target, shifting the inflation band is lunacy. And I maintain that view still. So, I'm kind of hopeful that this thing just keeps getting pushed out. We get our interest rate cuts. Put fixed income, and it's something that I think the people here have brought together. Fixed income is like a little bit of a Lego set, and you can actually build bonds together to give you a solution, or you can take a different set of bonds and build a very, very different risk and return profile. So in terms of what profiles have we built within our portfolios, I'm going to highlight two today. Obviously, there are others, and I'm going to highlight two we're frankly a lot better at. And the first is a bond fund, a long-dated South African bonds, absolutely fantastic for living annuities. You're locking in CPI +5 over long periods. And, those bonds right now are yielding anywhere between sort of 10.5%, 11% in absolute terms over time. Very attractive. Back when I was a kid, investing in equities for 10% return was a good thing. You can now do it in bonds with half the risk. The other profile I would talk about is what we call our core income, which is the ultra short dated. It's kind of like a money market fund on steroids, generating about 8.5% net of fees. And, that's been absolute winner for investors as well for short-term cash. Final question, the credit market. Now, the first point I'd make is, Rowan said it earlier again, back in the day, there were 25 bonds in South Africa. They're now 2,500. With 2,500 bonds out there, I absolutely expect that there will be defaults. It's just statistically impossible that you're going to have that many bonds without defaults. Defaults are normal. Defaults are part of investing in fixed income. The art in fixed income is being able to manage that the risks on that are, manageable, and that if something goes wrong, it's a minor incident for the portfolio. It's not going to stick out. We spend an incredible amount of time and effort on making sure that even in the worst case scenario, our portfolios are defensive. So, that's how I'd start it. From the market itself, first comment, I don't have anything out there that worries us tremendously right now. We continue to be a little bit cautious on state-owned enterprises. I know Transnet, for example, is state guaranteed, but yeah, we still don't like it. The other point I'd make is that credit prices have come down. I think justifiably so in most cases. I think South African credit was probably a little bit cheap. It's probably a bit more fair now. Interested to hear what Conrad says on that. Where we are maybe a bit more concerned is your tier one paper for banks. I think, it's been seen as a bit of a gold rush. You've seen a major spread compression, and I'm not convinced that the credit spreads that you're seeing right now are fully reflective of the risks. So we're probably a little bit more cautious on it than we were back when, the credit spreads were 4%. I'm going to leave it there in the interests of time, Roelof, unless there are further questions.
Thanks for that, Nolan. Conrad, your response?
Yeah. Thanks, Roelof. Yeah, just on the money market side or the short end of the yield curve side. I mean, there is an argument to be made. Well, if the MPC don't cut now, then when will they ever cut? Growth is quite substantially below trend, and inflation is below the bottom of the target band. So kind of, if not now, then when? I mean, when I've asked them this question, they point to a variety of sort of different factors that they're piecing together that worry them about the forward-looking prognosis for particularly inflation and risk, and therefore, they tend to have their hand on the handbrake a little bit. They point to the fact that almost all global central banks are running either neutral to restrictive monetary policy. There are very, very few exceptions that are running outright easy policy. Now, don't know exactly what the right number is, but there's enough work to suggest our neutral monetary policy rate is around 7 to 7.25%. So, if they follow the herd and run neutral to slightly restrictive monetary policy, that means, there's room for another 25 to 50 points of cuts, and then they would start to be going outright accommodative. Now, of course, the global backdrop could change, and there could be a wholesale move to more accommodative policy globally, and they would likely then follow. But as long as they kind of keep this sort of perspective, there's room to cut in our view, but they seem a little bit, sort of reticent. They are adamant that they're not running tighter monetary policy in order to achieve the inflation target, in the background. I guess the jury's out on that. They claim, well, why would they target something secretly when part of the appeal of inflation targeting is you communicate openly and you drive market expectations to the level that you want them to go. You're not going to do it through the back door through running higher rates. So I think it's a coin toss on further cuts, to be quite honest. The implications for income portfolios obviously is that certainly in our fund, the bulk of the instruments are floating rate in nature, and obviously rate cuts would then bring yields down. So a large portion of the portfolio would move down with a lag in response to rate cuts. So that's the first kind of flag to suggest the comfortably double-digit income yields on most income funds are likely to be under sort of downward pressure from rate cuts. The bond market then, which is the second sort of lever in a portfolio, is being driven by slightly different factors than monetary policy, particularly if you go out along the curve. And there we're getting massive yields from bonds relative to cash and inflation, which makes them really attractive, but with the potential for elevated volatility. We've spoken about the vulnerabilities in DM bond markets. We haven't really touched on our own sort of fiscal vulnerabilities and political uncertainty, which I think does keep risk premium in our bonds, fairly high. So, but if you can just avoid the big sell-offs in bonds from here, you're going to earn a really, really attractive yield with the potential for even a pullback. So bonds should come quite close to delivering double-digit returns in our view. So you've got a portion of the portfolio that's delivering probably 8% on the floating rate side. You've got another portion of the portfolio that's delivering double digits. And then you add in some credit spread, which I'll touch on now. And I think you're getting yields that are close to double digits on these funds, but probably coming down and possibly dipping into single digit territory would be my best guess at what you can expect from your average sort of income fund. The third lever that I'll end off with is credit, and obviously we lend money in our portfolio, as do a lot of other income funds, to a range of different counterparties, and our kind of job is to assess whether the credit spread you're getting over some sort of money market risk-free type rate is commensurate with the risk you're taking. Now, I've got a slightly different view to most, in the sense of, our numbers suggest that if anything, credit investors locally have been overcompensated by credit spreads for the risk that they're taking. And therefore, this big move in spreads tighter, while I'm absolutely not dismissing it, okay, I'm not suggesting credit is raging cheap. It's more of a move towards more appropriate credit spread levels for the risk you're taking than a move to outright stretched and overvalued and you shouldn't touch credit. Again, not dismissing the challenging macro backdrop we have as well, but credit quality we find is still fairly good, fairly defensive. The guys have de-risked balance sheets a lot, through COVID, deleveraged, and we still find fairly decent opportunities in the credit market. You've just got to make the mental shift that getting paid 100 points for a corporate instead of 150 points is the reality now, and if you're comfortable with that from a valuation perspective, then that's where the market is. So things like the moves in tier 2 and AT1 bank paper, are not surprising then. I mean, those are not going to stay wide when everything else has come in. Those have arguably been too wide in the past, and you've had senior bank spreads literally almost halve, and senior bank spreads coming in that much are going to drag tier 2 and AT1 spreads down with them. So I don't think there are any extraordinary credit risks that one should be concerned about. It's just valuation and whether you think, the spreads that are being paid in general compensate you for the risk and are going to cover your, as Nolan said, your expected losses, because there will be expected losses in a diversified credit portfolio over time. Are you getting paid enough excess yield? Yeah.
Thanks, Conrad. The last question is a question we normally ask as a DFM to fixed interest and any manager out there that we invest with. And for us, it's important to understand what makes you different relative to your competitors. And also, if there's anything that you've learned over the last, well, we can say 5 years since COVID, there was a liquidity event in March, and there was some credit events throughout the last 5 years. And then I can even go back and say over the last 30 years. So I really want you to spend a minute, only a minute, and I'll time you to distinguish what makes you different as a fixed interest manager in South Africa, and anything that you want to share with the viewers in terms of what you've learned in your mandate over the last 5 to 30 odd years. So Jonathan, you're up first.
Okay, thanks. So the first thing I'd say is I've learned to prepare and not to predict. I think it's been well put. Prepare meaning that position the portfolio in the best way to kind of achieve its objective. We've got a risk framework that provides guardrails that continuously get kind of analyzed, and we do a lot of scenario analysis. And the other thing that I've learned over the 30 years is in South Africa, certainly, to expect the unexpected. You might want to buy a bond now that you think is extremely cheap or whatever, but you need to also be aware that things can change quite materially, and you need to ensure that your downside is relatively protected, particularly in the type of funds that we're speaking about. And in terms of why us, I think the fund's been around since 2012. It was launched as an unconstrained fixed income fund. The design of it has been such that we did not have to change the DNA of the fund to adjust to market conditions. It's never been a credit fund or a duration fund or inflation-linked fund. It's been a fund that can do all of that over time, and it's kind of proven its worth over that period.
Thanks, Jonathan. Rowan, you next.
Let's go. I've learned to free myself from the tyranny of self-delusion. Okay. So I'll go back 36 years. De Klerk's speech on the 2nd of February, 1990, assassination of Chris Hani. Let's go much more recent. Invasion of Ukraine, tariffs. Okay. Forget about it. You can't do it. Now, the great news, one of your other questions that you suggested yesterday, I'm going to weave in quickly. You do not need to be able to forecast yield direction in the bond market. I and my recently retired colleague, Craig MacArthur, have done this in tremendous depth using very sophisticated. We've reconstructed the All Bond Index every single day over the last 18 years, decomposed every single bond and its weight as it was each day over 18 years into 7 different factors. Income accrual, roll, amortization, and then we decompose yield change into parallel and non-parallel. Here are the quick facts. The yield curve, the yield changes have been close to immaterial and complete white noise, or what physicists call white noise. The brilliant book, A Random Walk Down Wall Street, is 51 years old now. Everybody should read it. Yield changes are random, unpredictable, and unusable, but they have contributed over, real quick, over those 18 years, the All Bond has returned 343%. Of that, changes in yield, parallel or non-parallel, have contributed minus 16%, or as a proportion, 4% of the total return. Income accrual has contributed 393%, or 114% of the relative return. This is why we call our game fixed income, guys. So where we do things differently, I don't know, because I've never ever in my life snooped on my competitors, so I don't know what they do. But thank you. I immunize alpha of portfolios against interest rate moves, and I assure clients of yield enhancement. Finally, I never have and never will promise any level of relative or absolute performance. I do promise my most concerted efforts in the interest of our clients at all times. And we have generated alpha for 35 years. But whether we will, I won't promise. I promise my best effort. That's the BCI Bond Fund.
Thanks for that, Rowan. Nolan, you're up next.
Thank you. So it is a foot race to get this done. So I'm going to just pick one learning. There are plenty of them. I'm going to pick on the land bank default. And I think the disarray of the land bank default was actually eye-opening. The government actually doesn't really have legislation that caters for a state-owned enterprise to default. It doesn't really know how to deal with this. It actually was a heck of a lot more problematic than just dealing with a traditional corporate default where actually, the Companies Act works. So from that perspective, yes, the land bank was guaranteed. It was still an absolute freaking nightmare. I've still got tiny legacy positions in the portfolio. You know what? Be careful of government guaranteed bonds. Yes, they're guaranteed, but it still takes a heck of a lot of time and a lot of agony in your portfolios. Not worth it. What are we really good at? We spend the majority of our time working on diversified portfolios. Diversification is the only free lunch in investing. Okay, I'm not going to call the direction of the bond market. I am going to focus on, positioning so that we can, earn the most we can in a lower risk environment. We do take directional views on the market slightly. I think there are longer term trends that do persist within economics. We've all been talking about, yes, yields have been going up for the last 5 years. You've been an idiot not to see it. But, from that perspective, you've got to be very, very cautious when you take it. It's got to be measured risks. And overall, when you sum it all together, we're not the portfolio that's going to surprise you. We're not going to shock you. We're not going to rattle your cages. What we are going to do is deliver a consistent, predictable outcome in line with our mandates. Anchor BCI Core Income Fund, Anchor BCI Bond Fund. Those are the two to focus on.
Thanks for that, Nolan. Conrad, the floor is yours. 1 minute. We're over time, but you've got your minute.
Thanks, Roelof. I know I'm supposed to give the audience comfort as a manager of their money, but I'm brutally honest. Sometimes I feel like the more I do this job, the worse I'm getting at it. Can you imagine a doctor that got worse the more you operated? But I'm trying, and I think, there are a lot of lessons learned, but it feels to me like an environment where kind of big, and Jonathan referred to this, big shocks and big left field events are more frequent and more likely to happen. The world is a very sort of fluid place. I'm used to many years ago to really predictable economic cycles, and you just put on a duration position for 2 years and you rode the thing, all the way. So a very fluid environment is an eye opener, and it's come into our portfolio construction process. We are very, very focused on making sure the risk taken in the portfolio is commensurate with the return. And I sometimes think in fixed income, because there's a chase for yield and that desire to push out that extra 10 or 20 bips to get you up the peer rankings is tempting. We are sort of not peer cognizant. We're benchmark cognizant. And the risk in the portfolio is appropriate for that stage of the cycle and for the more fluid sort of markets that we manage money in. So we manage a really simple, consistent multi-asset income fund that is very risk cognizant, that has got quite strong downside protection targets in place. So we try not to lose money over a quarter, and we try not to underperform the STEFI over any given year, while capturing as much of the risk premium that's available in fixed income assets. And it's just a no surprise sort of multi-asset income fund. Is how I would categorize us. That's the Alawani BCI Flexible Income Fund.
Conrad, thanks for that. Nolan, Rowan, Jonathan, thanks for your contributions today. Highly informative, and I'm sure the viewers will agree. Experienced individuals. I think there was 1 or 2 questions that we didn't have time for. So Eugene, you and your team, if you can go back and maybe ask those questions to those specific managers, I will appreciate that. And thanks for the opportunity, and have a great day, everybody.
Thank you.
Thanks, guys. Cheers.
Thanks, everyone.
Thank you very much for that. Very insightful indeed. And yes, we'll do that. We'll circulate the open questions to the presenters and get some answers on that. To all of you, to all our panelists this morning, thank you so much for your time. It's been very useful indeed. Outlook for fixed income still looking very positive, but you need to manage those risks and trust in managers that's been doing that for a very long time. And if you're not sure who they are, phone Roelof, he can tell you exactly who they are. Right, team, thank you very much. And to our audience, thank you for your continued support. We really appreciate it. Quick reminder, next week, Wednesday, 4th of June, we've got Fair Tree and Methodical. Looking forward to seeing you all again next week, Wednesday. Otherwise, have a fantastic week further.